Hello, everybody. This is Chuck Carnevale, co-founder of FastGraphs, the Fundamentals Analyzer software tool. And it's my pleasure to bring you this video on FedEx Corporation. For those of you who are following the stock, you'll know that they just reported earnings yesterday, and they really handily beat all consensus estimates. And as a result, the stock has been performing extremely well for the last couple of days. Last time I looked, it was up about 12%. Today it's been up as much as 17% or 16% or more today. So the stock is hot. But one of the reasons I wanted to showcase this particular company, in addition to the fact that they had a really good earnings report, is this is a classic example of the importance of fundamentals as it relates to how and where a stock price of a good company is going to go. So let's take a look at FedEx. I'm going to start with adjusted operating earnings here. As you can see, the stock price, which is the black line, has really tracked earnings over this roughly 20-year period. This goes back to 2001. And you can see that, there's not a perfect fit, but it's pretty close. The normal valuation over this time frame has been about 17 times earnings. The calculated fair value is 15 times earnings. In other words, the orange line on this graph is a PE of 15. The blue line is a PE of 17.7. So as you're looking at this graph, keep that in mind. And you can see that the stock has really tracked earnings. When the stock price was rising, the price was rising over the longer term, with obviously the volatility that always occurs in between. When we came into the Great Recession and earnings fell, the stock price followed suit. And then as we came out of the Great Recession, we had this long surge in earnings growth that's lasted here 7 or 8 years or so. And you can see the stock price followed that. Now, also notice a couple other things here, which I like to always point out. Number one is there are times when it gets disconnected. This is a less than optimum time to invest. This would be a really optimum time to invest. Anywhere where it's on the orange line would be a great time to invest. This was less than an optimum time to invest, but when it got undervalued here in February of 2016, that was a attractive time to invest. But because fundamentals did drop as a result primarily of COVID and deciding to cancel the Amazon contract, your rate of return would have been rather anemic, but it was related to the fundamentals of the stock. And I think that's what's so important. I want you to see that. So I really like showing this company because of the relationship between earnings and price, how price follows earnings so beautifully. And this is adjusted operating earnings. Now, just to familiarize those who aren't familiar with my graphs, this white line is plotting a dividends. As you can see, FedEx has only been paying a dividend since 2003, but they've grown that dividend very nicely. Their payout ratios initially were very low. Here's a dividend payout of 6.9%. The area below this white line is a graphic picture of the payout ratio. Then the payout ratio got higher as time went on. And you can see that payout ratio getting higher and higher here. Here we're up here at a payout ratio of 9%, then it goes up to 13%. And recently it's been about 16 or 17%. That's a very attractive payout ratio. Now the stock yields about 1.85% as of yesterday's close. Unfortunately, the stock price is up a little bit today, quite a bit today, about 12%, as I mentioned. So it'll probably be yielding a little bit below that. But if I look at the long-term performance, notice that the growth rate here is 7.92%. And the stock was reasonably valued at the beginning. And it's basically back, as of this particular time frame, back to about almost a 15 PE again. So we're going to see capital appreciation. It's going to run in that 7.9 range. In other words, in the long run, earnings determine market price, and the rate of change of earnings is going to determine your capital appreciation. So when I go to performance here and look at it, you can see that we ended up with a 7% annualized capital appreciation, or rate of return based on price action alone. Now, we also had the dividend since 03, and the company would have paid another $4,000 in dividends. So your original $10,000 grew to $39,498. You add in $4,000 in dividends, you got $43,000, and that significantly outperformed the S&P 500 over this, long-term time frame here. Now, there's other metrics that are critically important. One of the metrics that Warren Buffett allegedly considers perhaps his favorite metric, at least it's alleged he does, is owner's earnings. And owner's earnings includes CapEx. And one reason I want to show you this is the relationship between owner's earnings and FedEx is also quite profound. You can see how the price really tracks that. The stock did get dramatically overvalued, going into 2018, 2017, and 16 mostly. But then we had a drop in owner's earnings. And if you followed the company's recent report, management suggests they're going to cut CapEx spending. And I think that's part of the reason. I believe the analysts have taken that into consideration. So we're expecting this surge in owner's earnings of about 71% for this coming year. And that's another reason why I think the stock is, very undervalued based on the owner's earnings. Other metrics that I like to look at, I also would look at GAAP, but GAAP isn't so much for valuation, which is kind of what I'm focused on here. Let's look at operating cash flows, because what I want to see here is operating cash flows covering the dividend. And when you look at FedEx, you can see that the operating cash flows are in the $17 to $20 range here, estimated to be $24 next year, and they're paying about a $2.60 dividend. So the cash flow dramatically covers the dividend. Now, also note that the company has 62% long-term debt to capital. And again, they're trading at a blended priced operating cash flow of 7. Their operating cash flow yields over 14%. That's very, very attractive. Now, the one negative on this particular stock, and I haven't had a chance yet to look into it, it might be something y'all who are interested in looking further might want to take a closer look. The company's free cash flow has actually been negative for the last 3 or 4 years. Now, I don't use free cash flow as a valuation reference mostly. In fact, I often take price off when I'm looking at cash flow. What I'm really looking at here is, I guess you'd say, dividend coverage for one thing. And does the company have cash left over after what they have to spend to run their business? And we've had a little bit of a hiccup here for the last couple of years. So that's something that I think you would want to take into consideration. The next area that I thought would be interesting to look at is price to EBITDA. And I'm going to go ahead and put price back on the graph here. You can see that the stock price has tracked EBITDA. Again, the correlation between operating results. We've looked at earnings, we've looked at cash flow. Now we're looking at EBITDA is very, very profound. The business results are ultimately what generates where the price movements. In the short run, you do get these disconnects, where the price deviates from the fundamental value. And if you read the written portion of this article, one thing I talked about there was the studies that were done by JP Morgan, Bank of America, I believe in Princeton. It's in the written portion, where in the long run, fundamentals generate 90% of the returns. In the short run, valuation and fundamentals, I should say, generate return. But in the short run, investor sentiment can have a great deal of impact, where we get irrationally exuberant, where you have these high levels of valuation, but we always get these inevitable reversions back to the actual fair value or theoretical intrinsic value of the stock. So FedEx looks extremely cheap on a price to EBITDA basis. And then, if I go looking at the forecasting calculator, EBITDA, which is a form of cash flow, really, it's earnings before interest, taxes, depreciation, and amortization. The rates of return for the next couple of years on this stock could be double digit and very, very attractive. Now I'm going to very quickly go back to adjusted operating earnings here and also calculate expected rates of return. Now the company has a May fiscal year, so their fiscal year just ended. And here we are, at the end of June. It takes about that long, or the beginning of July, it takes about that long for the companies to, audit all their financial statements. So they just reported on Tuesday. And the bottom line is we look at a double digit return coming up this year because there are 22 analysts that expect 7% growth for this fiscal year, which ends May 2021. However, the following year, we're expecting 22% growth, followed by 16, followed by 5. Now, notice the number of analysts drops off to 16 for 2022, down to 3, and then down to 2. So when I'm looking at these graphs, I tend to spend a lot of credence in these couple of areas. Now, when I look at the analyst scorecard, I'm trying to see how accurate analysts have been. I will point out, partially because I think of the cyclical nature that you've seen in the historical graph, they do miss about 36% of the time with a margin of error, but they also beat 9% of the time. When they're doing 2 years forecasts with a 20% margin of error, the analysts have missed 27% of the time. And there's the granularity. Sometimes their misses are big, sometimes they're not. So that's something also that I like to consider. But bottom line is, the company is looking pretty attractive here on a valuation basis, looking at price to adjusted operating earnings, as well as price to owner's earnings, as I showed you a moment ago. Now, next, what I'd like to do is look at a couple of issues that I think are important to consider when looking at this stock. So I'm going to go into the financial underlying numbers here, fund graphs as we call them, and I'm going to shorten the graph. What I want you to see is that the company has added a lot of debt here recently. This is, through May. And the company's total debt per share is actually gotten pretty high. But here's the area that I really want to focus on. I want to look at share buybacks. And I'm going to look at these share buybacks since coming out of the Great Recession. In May of 2009, the company had 31.2 million shares. That's now down to 265 million. And now they had 312 million in 2009. I misstated that. The bottom line is they've reduced their share count by just a little over 1% a year annualized since the Great Recession. I don't consider that too bad, considering the fact that the company has, been undervalued or at least fairly valued for a significant portion of that time. And again, it's not an egregious share buyback, so I do consider it okay. The negatives are, I don't like their current free cash flow generation. I'm hopeful that the company will fix that. I do like the current valuation. Keep in mind, it's a little higher than what we have here. The stock is up in the mid 150s now, the last time I looked. But we do have, expected growth going forward. The company is BBB rated. It does have, again, a lot of debt, which it just brought on, but they do have the cash flow to support the debt. And their payout ratio is so low that I think their dividend is obviously going to be relatively safe as well. The analysts are forecasting a flat dividend for this fiscal year versus last fiscal year, and maybe a slight increase in the dividend next fiscal year. Anyway, I think FedEx is a very interesting company. Their earnings report was, as I pointed out, excellent. It's showing that the company's making a lot of progress. You can go into the transcripts and read about that. The company's earnings are something that I think you should look at because the analysts were really expecting less. If I look back at the forecast for operating earnings, I want you to notice that the analysts were forecasting $12.23 6 months ago. Then it went down to $9.79, then down to $9.48. And of course, they came in at $9.50. But for the quarter, as I mentioned in the written portion, they were expecting about $1.52, and it came in at 2 something. So the company's essentially beating expectations currently. Their earnings did come in as expected as far as the consensus estimate at around $9.50 a share for this fiscal year. And again, we're expecting 7% growth next year and 22% growth after that. Anyway, if you like this video, you might also want to check out our Dividend Kings website on Seeking Alpha. We're focused primarily on high quality dividend growth stocks that are attractively valued. And we do offer a free trial, so you might want to take a look at that. Anyway, this has been Chuck Carnevale saying thanks for watching. Look forward to talking to you guys again real soon. And stay safe, everybody.